Welcome to the WangHiro podcast, where we answer Malaysians' burning questions about personal finance with fact-based answers.
If you haven't heard the news yet, experts are saying that EPF could be paying us up to 6.5% in dividends this year. So some of you might be asking, why is this happening? And what has that got to do with the money we have in our EPF accounts? Welcome back to WangHiro with me, Louis, and my co-host, John. On this channel, we talk about personal finance and investing for Malaysians. So today we look at the EPF dividends. Why is it going up? Or when it goes down, why does that happen? And for you personally, how do you position EPF in your overall investment portfolio? So John, we start off with this very basic question. Why are we seeing this jump in EPF dividends? And historically, it's been said that this is the highest payout, even in absolute numbers.
Yeah, I think more importantly is two things. The markets outside, because of prolonged low interest rate periods, and also stimulus. Okay, I know I realize that I sound jargony already. I'm going to put it down into simple. In the past, interest rates were low, money was easy, and because of that, during the COVID stimulus package time, a lot of governments was putting in money to prime the economy, people to try to encourage people to spend. But a lot of this money, where they ended up? Stock market. Remember EPF, they allowed withdrawal, they allowed all these kind of things, right? In the end, where did people put the money? They couldn't go to anything. They didn't put it in the bank. They put it all in the market, Louis.
And also gold and luxury bags.
Yes, gold, luxury bags, anything that in a way could generate, because this was surplus spending, and that has actually brought in quite good income for EPF, because a larger chunk of investments for EPF these days are outside markets already, external markets, compared to the domestic markets. Okay, domestic markets, 2021 was a good year, but 2022 wasn't a very good year for the KLCI. So that's one of the main reasons why we're expecting better payout. So going forward, is that something? No, before the going forward part, we want to address historically, how have EPF actually, done, whether they have done well or not, right? So I'm going to show you now a chart that was prepared by The Edge. I think it was in an article in 2021 or 2022, I can't remember. But yeah, so this was the historical payment of the dividends for EPF, and it started all the way back from record 2002. And Louis, you were mentioning if it's going to be 6.5, it's maybe one of the largest, right? The highest so far has been 2021. Remember when I said that 2021, easy money, governments around the world, the US, Malaysia had EPF withdrawals, US just print more money, right? And that's where equity returns was insane. Now, I think maybe for those of you who have never looked through an EPF report before, you're wondering, how does EPF make money, right? What are the components that make up EPF assets? So I'm going to go through very briefly, and because of that, it may not be 100% accurate, but it's roughly there. 50% to 40 to 50% of EPF's assets are actually in what we call fixed income instruments. So what do we mean by fixed income instruments? It's actually usually a bond, a sovereign bond, a loan that the government of Malaysia actually issues. And usually this comes in the form of this thing called Malaysian Government Securities, MGS. You think of it as the reverse. The Malaysian government is actually borrowing money from people who buy this MGS from them, and they pay them 3 to 4%. So let's just say I'm the Malaysian government, I issue an MGS. You are a big institution, you buy the MGS from me, but I have to pay you 4% yield a year. So in the end, you become the bank, I become the lender. Okay? And that forms a big chunk of what EPF actually has in their asset. The other part is actually equities. Equities form somewhere between 35 to 40%. Okay? But this equities part actually forms the bulk of the income, or the bulk of the, because if you do well, 30% times 100% is a lot, you know. But you know that the 50 to 60% in fixed income, the max they will pay is 5-6%. Am I making sense to you, Louis?
Yeah.
So you have one chunk is big, but it's safe. It gives you that 5 to 6 every year. Okay. But you have a smaller chunk, which is then it makes it less risky, 30 to 40%. Equities, no upside, no limited upside, but there's also unlimited downside. You could lose a lot of money, right? But this is where it has been delivering year on year much of the needed income that gives us that kind of what do you call it? That kind of dividend. You see a lot of people, wow, they look at 5-6% EPF, right? They are very, very happy, right? And then they said, oh no, stocks are very dangerous. You know, cannot invest in stocks. But that's where your money is coming from. Hello, guys. Equity forms the bulk of the income for EPF. Obviously, they have a huge resource. They have great research teams, portfolio managers that manage all this risk for you. But yeah, equities is the best asset class that delivers the returns again. Okay, so as you can see, it crept up all the way from 4.25. I think at the peak was 5.65, 6.4, 6.9. Oh, sorry. The blue is the Sharia one. So it's actually the red one. So in 2016, 2017, they introduced the Sharia, Simpanan Sharia. So the blue ones are actually the Sharia savings dividends. Okay. And they are limited because they cannot buy non-Sharia components. So usually banks, utilities, all that. Yeah. Highest so far was 2017, 6.9, but EPF was much smaller than. Today, EPF is 1 trillion, you know, it's quite crazy. Okay. Now, here's an interesting figure. The whole of the second quarter of 2023 alone is the highest so far already. In terms of investment income. That means one is 18 billion already, okay? It already beat, let's just say maybe even quarter one plus quarter two combined of 2022 is already more than that. Almost. Okay. And if you look at it on a yearly basis, the first 9 months of 2023 is already beaten that of the first 9 months of 2022. Has not beaten 2021, but it's on par. It is definitely over that of 2022. So what they're expecting is if like fourth quarter is going to be very, very lousy. They haven't announced the fourth quarter investment income. Even then, which is not the case. Actually, S&P rallied, right? So definitely, very likely. That's why the experts are saying that it's going to be a bumper year for EPF's dividend. Okay. Now, again, this is what I explained. I should have used this graph. This is what I explained earlier. 2020, equities form about 30%. 2021, you see equities form about 40%. You know, fixed income actually came down, which is good. All right. And then so you see a fixed income plus money market, you can lump it together. Real estate and infrastructure, probably about 10%. Okay. And as more and more equity, right? As more and more they are putting into equity, that's where the income will actually come from. Actually, I'm not too happy with the Prime Minister saying that EPF, please bring money back. Institutional GLC, please bring money back. Our market's too small. I know it's a political thing, right? But our market is just too small to support that kind of money coming back in, you see. Yeah. Obviously, the Prime Minister means well. He wants to, prop up the Malaysian economy. But is our market competitive enough to be able to handle that kind of money? That's a question.
I mean, looking at these kind of like shifts in the equity, what would determine them like investing more or less into equity? Is there like a framework around it?
Definitely, they have the investment committee. Actually, do you know that even EPF they have angel and PE investing? They actually they have a section. I covered this in a video I did in the past. They actually gave $200 million to PE funds in the US. And that's why my hypothesis at that point of time, I said EPF is the lowest hedge fund that a Malaysian can afford. We don't pay anything, right? It's contribution. We pay a very little management. Yeah, we pay very little. We pay for the salary of EPF as they minus off operational costs, but it's minimal compared to if you were to pay a real hedge fund. You see. Yeah. So to your question about how do they determine, it changes year on year. It changes based on valuation. And if you look at how the endowments of the world, the Yales, the Carnegies, the Ford Foundation, right, they actually change asset allocation class every few years. So it's not to say that it's a hard and fast that this is when, but it's based on a rule to say, hey, valuation in the private equity markets are cheap. Then they start switching.
Okay.
Or you said now, if you look at public markets today, so there is this thing called a Buffett indicator. So what they do is this: they look at a country like a GDP. They look at a country's GDP like a company's output. So the country's GDP, let's just say, is a certain number, right? And then they look at the public markets. What is the valuation of the public market cap versus the GDP? If it's like too high of a multiple, let's just say your entire country is only putting out 1 trillion in terms of economic output, right? But your market cap is 10 trillion. That means 10 times that of your GDP, then something's wrong. Because
Okay.
your valuation is all about valuation, perception of the market, right? But it's 1 time, 2 times, or what a reasonable number. Then you know, public markets are not too frothy. So in most markets, we also look at it like, okay, if Malaysia or Bursa Malaysia's companies, the average PE of market caps is about 16 times valuation, that's considered okay. But on average, if it's like 40 times, 50 times, that means on average, all the company's market cap is priced 40 times, then it's actually very, very frothy already. Am I making sense or not, right, Louis? It's like, yeah. Is the market pricing it too much? Or is the market? Then if average market cap to a PE ratio in Bursa is about 3 times, 4 times, then you know something is wrong. Economy is still going well. We still have the AAA rating or BBB or AAA minus. You know, we're not going into default. GDP is still growing 3-4%. But on average, all your companies on the stock exchange is trading at average PE ratio of 3, 4. Then you know it's undervalued. Actually, now Hong Kong is like that. But Hong Kong the problem is the geopolitical tension. But in terms of value, if you look at the companies there, you see net cash companies, the cash is even more my market cap, PE of 3.
Oh.
Yeah, but will you dare buy?
No.
That's the question. That's the risk. You know, that's the risk you have to handle as an investor. Yeah.
Because I think in a lot of the episodes we cover under stock investing under zero, that's one of the indicators, right? The PE,
Right.
like how the expectations are baked into it.
Yes, you are absolutely right. The markets bake forward expectations. Either back it lower or higher. You know. Yeah.
So as account holders of EPF, right, we're seeing, here we're seeing some rise. So should we be expecting like this to be somewhat of a new normal, or can we expect to go even higher than that?
I caution against too much optimism. One. Secondly is this. I feel that the world of easy money is gone. I mean, Howard Marks just came out with a very excellent memo. It's just called Easy Money, right?
Right.
And he actually documents the history about inflation rates and interest rates and its relation to the stock market. And why I felt that it's good, because I grew up during secondary school in a day where interest rates in Malaysia was about 10%. And, you know, when I was working as a technician, as a 16-year-old, you know, while waiting for my 17-year-old, while I was waiting for my results, was that I had colleagues who were technicians or engineers. They were taking on housing loan, 30-year fixed housing loan for 10%. Okay. For me, that was too high of an interest rate to pay, that it moves asset prices beyond that of a normal man. But at the same time, when I contrast that to post 2008, post the global financial crisis, where interest rates was zero, even negative, right? I think that encourages reckless spending. On one hand, at 10%, people are too cautious. Nobody wants to buy. Businesses were stagnant, right? But on the other hand, when it's like too low, then that's where reckless behavior will actually manifest. Actually, I think it's Morgan Stanley or JP Morgan. They did a graph, Louis, and it was very interesting because they actually benchmarked the S&P 500 performance against the interest rates. So what were the interest rates? What are the range of interest rates that dictated the performance? So the highest was when interest rates was between 2 to 3%. The S&P performed about 13%. I can't remember the other figures, but I remember when it was interest rates was more than 5%, I think performance was less than 10%. I think 6 or 7. You see?
Wow, that's quite interesting, and I think that also makes us have to think about both sides. Right?
Correct. So it's a
It's
very
balanced.
strong correlation, interest rates, inflation against equity performance, because cost of money ma. You want to start business, there's always a cost of money. But when cost of money is very, very little, then you struggle again when reckless behavior manifests, you see. So there's always this balancing game. And I think that's where EPF, for me, and kudos, I've said this many, many times, even in my previous video, kudos to the EPF team, because they have to navigate through all this. And more importantly, they have to navigate through political interference as well. So, there's always like, hey, put more money back to the investor or allow people to withdraw. And then when you allow people to withdraw, whatever investments you have, right, that was meant for long-term 5 years, you have to draw down, you have to start liquidating, you see. So it's not
Those are the
easy.
things we don't consider as
Exactly. If your own personal portfolio, there's nothing you need to consider for those criteria, you see.
yeah. So given that we can't really predict, right? Obviously, we shouldn't be predicting, either side. How should we handle this kind of news, right? When it comes to our own investment portfolio, right? So most people, I think, like they have to put like a certain percentage into EPF. So would we say, like, if we see some positive news, what if it goes on for another couple of years? Should we now then put more money into EPF? Do you think?
I think it boils. Okay, here's the nuanced answer. I think it boils down to the individual, and I'll tell you why. Now, I know a lot of audience people say, "Give me a black and white answer," right? And I tell you, it's not a black and white answer. For someone of my skill set, and people who I know of some fund managers that can compound at 15, 20%, right? If they have an option where they can take their own money and invest and rely on their skill set at 15%, or don't say 15 lah, even at 10 to 12%, and they have an option not to put into EPF, why would they want to? They already know that, right? They already have that skill set to double that of EPF. But for the vast majority of people who don't know how to manage money, people who don't have the skill set, it's not that they don't have the time to do it, then EPF is a very good. It's like what Buffett said, 99% of people should just invest in ETFs. That's exactly what I'm trying to say. You see, for a small niche set of people who knows how to manage their own money, they wouldn't put money in ETF. They would invest in businesses, they will invest in other asset classes that can bring them, better returns. But for those who don't have the skill set, then I think this is where EPF is the best. 95 to 99% of the people will just put their money there. And that's where, like for me and you, we run businesses where EPF contribution is voluntary. This is where that options game is very, very important. Because for me, I have a sizable EPF. Thank you, to my previous corporation that hired me. I was very lucky. But if you ask me to contribute more, I wouldn't. I know what to do with it, lah. You see. But does that rely to you? Does that depend on you? If you don't have the skill set, then put by all means put everything into ETF. But if you have alternatives and you know how to work those alternatives, then look at EPF as one source, then you develop another source. I have friends who EPF, they just say, EPF is a bonus to me. What? Because they fear, wow, what if the government collapse? What if, the aging society takes up a lot of these benefits and the younger generation, there's nothing left in EPF to draw down and all. They also have to worry about those risks, those people who can take, you see.
So interest rates aside, right? Is there should we have a cap on how much we put into EPF?
I think they raised 60,000 to 100,000 now.
I mean as a percentage of our own portfolio, for example.
Okay. Okay, I'm just trying to think of whether what would be. If you don't know how to manage money, I think put in as much as you can. If
Really?
you, yeah. If you don't know how to manage money,
That's safe though. I mean,
Yeah.
compared to
but here's the downside.
yeah.
The moment you put in money, you can only withdraw at 60.
Oh, that
Okay.
liquidity problem. Yeah.
Liquidity is one. I'm saying this to the extreme cases where people want somewhat they perceive EPF 5% is guaranteed. That is the mindset of this group of people. Okay, they don't understand or cannot quantify risk. Then there's this middle tier. They understand a little bit of risk, but they don't know how to manage, right? So then they start outsourcing to either a unit trust or private mandate or whatever. Then I would say balance, because you know why? If they can take advantage of a employer matching contribution, then for me max it out. But if you are like a freelancer, then I said, and you fall into this category where you know a little bit how to manage it, then I said you shouldn't max it out.
Right.
Okay.
Okay.
First year, don't know risk.
Mm.
Don't have other income streams, don't have business income streams, don't want to take any risk, max it out. Second tier,
100K a year.
yeah, 100K a year, salaried, matching 100K a year. Second tier, you may be a freelancer, you know how to manage a little bit of business money, investment money, and then you think you can outsource. Okay, then you do allocation. Maybe if you feel that you have more time, then 60% you take off, 40% you go into like EPF. But then caveat, only you can withdraw at 60. Okay. Then the third group of people, which I mentioned, people who are in the business of investing, understand portfolio allocation, whatsoever. I don't contribute. I don't believe I should contribute because I can better utilize or better sweat my asset. But this, again, very small chunk of people. Chunk of people.
So like, what if like there are people like for me, I would be worried about like just putting too much money into one place and then
Yes.
again a liquidity problem. So other than EPF, right, what would you recommend? Something similar to EPF?
Yeah, I think a good broad-based ETF is the best. Why? You don't do individual stock selection. You just follow the market. Okay. You at the end of the day, equities as an asset class over long periods of time has delivered. So if you're not worried about market timing, you've got, let's say, 10, 15 years of 10 years, 15 years of runway. Broad-based ETF, very low cost. Fantastic. The problem is a lot of alternatives today, alternatives to EPF, are very high cost. Unit trust is very, very high cost. It may not be the fund manager's fault. It's the structure in itself, because there is an incentivization scheme to have to distribute this unit trust, and that's where it eats up into the investor's cost. Why I'm putting this up is because you asked for alternatives. If let's just say they understand that fees are very expensive, but they're not willing to pay fees even if it's a good fund manager, then I think you have the wrong mindset also. Let's just say the guy charges you 3%. Let's just say, or 5%. Worst case, 5%. But every year can give you 15%. So 15 minus 5 is delivering 10%, which is still double of EPF. Will you not pay? I pay.
Yeah.
I would pay.
Worth
Happily
paying
pay. Yeah. Again, is this, a lot of people want binary kind of answers. And I would argue, don't get binary answers, understand frameworks. And I, in earlier with Louis, I have to bring this up, we created content, and then, short form content, and then people come out and say, hey, John, you talk about this. Are you giving me an answer or not? I'm giving you an answer. I'm giving you an even better than answer. I'm giving you a framework, right? Fall into this category, don't want to think, don't want to upgrade yourself, fine, put everything in ETF, in EPF. You want to upgrade yourself, do something about it, can. Broad-based ETF, understand what is a bit about stock investing, go for your ETF. You want to upgrade yourself even more, full-fledged, go active fund management, understand what are stocks, do individual stock selection. Okay, yeah, that would be how I would do it. And That's where I realized after training more than 6,000 people, Louis, we created this ETF compounders because, our first cohort, we opened it in Q3 last year. I think easily they're up about 6% already. Easily. I haven't checked the latest figures. And just broad-based ETFs, very low cost. Most people don't want to create a cost on ETFs. Why? Because there's no incentive to sell them.
Yeah, nothing to earn.
Nothing to earn. No one is paying them a commission. No one's paying us a commission to sell an ETF, right? How I wish BlackRock's paying me.
I wish, but no.
Or State Street is paying me, or Vanguard is paying me, but it's not lah, right? So if you're interested though, there is a cohort opening soon for Q1 2024. We'll put the links in the links in the comment section below. Yeah, that would be what I would suggest. Very broad based.
I think whenever I think about an alternative to EPF, and that's one of the reasons I want to bring it out, is because definitely people will say, oh, what's the alternative if we don't do this, right? And everyone's like, oh, most people seldom the alternative is unit trust or mutual funds, which again, like John, you brought it out a good point, which if there are fund managers good enough, then it's worth paying for. But statistics already show that 90% actually return less than EPF.
Yep.
That's last year's data. So
that's right.
I wouldn't be surprised to see if the data persists until 2024 as well. So this is the reason why we brought into we launched ETF compounders. So I usually leave the link. Okay, you can find it. We'll leave a comment with the link if you want to join the waiting list. So waiting list, if you join the waiting list, will also give you an extra discount. Okay, so once the doors open, you also get extra discount on top of any other discounts that we'll be giving out. Okay, so make sure to put in your email in the link. Okay, if you're interested.
Yeah.
All right. So I think that about wraps up.
Yeah, I do have one more.
Have one more?
Yeah,
Okay,
I do have one
ahead,
more.
sorry.
This is a very interesting chart. It's the world's 100 biggest pension fund. And before I show, maybe for you first, Louis, do you think our pension fund, the Malaysian pension fund EPF, do you think ours is sizable or not comparatively around the world? Just yes or no?
Yes. Yes, I think it's sizable. Yeah.
Okay, you think it's sizable, huh? Okay. So I'll just show you some stats and let's just see how it works out from here. Huh? Okay. India, population 1.1, 1.3 billion people, right? Which is virtually how many times that of our size, right? Their pension fund, okay, their employees' pension fund. Okay, right. See maximum I can zoom. Okay. It's about it doesn't seem to be growing any bigger, huh? It's over here. It's 89.5 billion. Now this is figures from 2021, 2021. 89.5 billion. Okay. Malaysia is here. Can you see here? Malaysia Employees Provident Fund is 242.6 billion. So we are probably about 4 times the size of that of India.
Wow.
Okay. This is Taiwan. Taiwan has almost the same population as us, 168 billion. Okay. If you look at Kuwait is definitely a much smaller nation, probably about 5 million, if I'm not mistaken, 160. So, but you have to remember they derive a lot of money from oil as well, much more than Malaysia. Okay. Australia has many, so that's why they have their, if you see here, their Sun Super, their Uni Super, their Away Super, the Australian Super. So they're the superannuation funds, right? A few cumulatively. So you got 60, 72, 96, 107. Okay. Now, obviously, if you see the blues here, these are all okay. Just take one. Ohio State teachers. That means this is the state of Ohio and only the teachers. Okay. Only the teachers is 95.1 billion. So when you talk about wealth, I mean the US just trumps it, right? But world number one, no one comes close, is Japan. 1.7 trillion, the government pension fund, the government pension investment fund, 1.7 trillion. Yeah, but even then, this still loses out to BlackRock. BlackRock's about 5 to 6 trillion, asset size. Yeah. So if you look at all this, you see all this in blue. These are all US, United Nations Joint Staff. This is Lockheed Martin. Just one company pension fund is probably bigger than one country. CalPERS. This is the California Public Employee. It's very famous. You go and Google CalPERS, people will know. In the fund management industry, you'll know lah. But their funds haven't been doing very well. EPF, in terms of performance, if I remember my research last year, it was top 10
Wow.
in terms of performance. Yes, it was on par with the Norwegian Sovereign Wealth Fund, which is here, is number 2. Okay, the German pension fund, it was doing better than the German pension fund and all that. So again, hats off to the to the Malaysian EPF team lah. Yeah.
So very, very capable fund managers.
Oh, definitely. And they outsource a lot of it also, Louis.
Oh, I see.
So they'll give, let's say, RHB here's 1 billion, or maybe
Right.
1 billion, because
Right,
it's so much money. Actually, a lot of money also. They need to outsource.
Yeah, you need a lot of people to manage. I think
Yeah.
a lot of brains to kind of think about what's the best way to allocate, right?
Correct.
Okay, so thanks, John, for sharing that. That was very interesting. John always has a lot of very interesting tidbits. That's why we keep going. Yeah, so I think that wraps up everything we have to say about EPF's upcoming dividend this year. It's not everything, but I think we've said probably everything you need to know. So if you still have any questions about how the EPF invest, or any what you should do with your money, you can always leave them in the comments below. So maybe you can also share with us how much of your money is currently put inside EPF, if you don't mind, in our comments as well. So will you top up your account? Also let us know. Okay, so if you want more content around personal finance, EPF, that kind of thing, make sure to like, subscribe, and hit the notifications button for more updates from WangHiro. Thank you again for tuning in today, and we'll see you again in our next episode. Bye-bye.